All right, here we go. So, good morning. This is Diversifying Retirement Income Sources. I hope you guys are well this morning and thank you for joining. I will jump right into the content. The previous live was the introduction. Hi, hey, Emily Morocco. Janetta Mahone, good morning. Alrighty, I'm going to jump right into it, okay? So this is a spinoff from the Secure Act that we've been covering for the month of March. And what I want to cover for you guys is I want to make sure that you guys stay focused and that you guys stay disciplined, okay? Because we are in a time where we are all completely distracted. And for most of us, hey, it's with good reason. But what we want to make sure of is that we come out of this, because by the grace of God, for many of us, we're going to come out of this, that we haven't gotten so distracted to the point where we are no longer in a position to stay on our target goals financially, retirement, deadlines, and dates that we've given ourselves, so forth and so on. Okay. So diversifying retirement income sources, what we're going to start off with is we're just going to take a look at whether or not we can afford to retire. It's a mindset, guys. So here are some stats that I thought were very interesting. Um, Average retirement savings, it says roughly half of all baby boomers have set aside only $100,000 or less in retirement savings. If you want to know what that means for you in terms of what is that going to pay you at the date or in the year, at the age that you think you're going to retire, I'll drop, excuse me, I will drop in the comments a link for you to submit an inquiry confidentially if you want to know what that number is based on your own retirement savings year to date. But roughly half of all baby boomers have set aside only $100,000 or less in retirement savings. It ain't gonna take you a long way. So older. Now, this publication is a little dated, to be honest with you. With the other 66% of retirement income sources coming from where other is typically what you have created for yourself, what you have saved. All right, that's what that other is. So this publication is suggesting that you need to provide for 66% of your retirement income sources. So if you are currently making $125,000 a year gross, you need to be saving enough money to whereas you're going to be able to, out of your own savings, compensate yourself $82,500 per year gross for every year that you expect to live in retirement. Okay, so say you actually expect to be living about 20 years in retirement, you need to have saved at least $1,650,000. I'm sorry, yeah, $1,650,000. I'm sorry, $1,650,000. All right, because pension plans are disappearing, probably have disappeared. Now, I did work with a very large financial institution a couple of years ago where they position afforded me access to a pension, and it almost knocked me off my feet when I realized how many retirement benefits were available to me. But what was even more appalling was how many of my colleagues, my co-workers, my business partners who had access to the same benefits were not taking advantage of them. And it was very, very common for the discussion in the office, because it was a bank, for the discussion in the office to be about how so many organizations no longer offer pensions. If you look at the number of Fortune 100 companies offering traditional defined benefit plans. In 1998, there were 64. By 2016, there were only 2. What do you think it is today? It's 2020. So, what I am going to do is for those of you who don't know, I'm sorry, I got distracted by text. Shame on me. But traditional defined benefits plan. For those of you who might be unaware of what that is, it's something that you all have probably participated in. It's a plan. A defined benefit plan is an employer-based program that pays benefits based on factors such as your length of employment and your salary history. The pensions are defined benefit plans. It, in contrast to a defined contribution plan, which many of you may also be participating in or at least aware of, that's more common nowadays. So in contrast to a defined contribution plan, a defined benefit plan is responsible for all of the planning and investment risk of the plan. All right, so the plan itself takes care of the investing for you. The benefits can be distributed at fixed monthly payments like an annuity or in one lump sum at a point that is defined, is predetermined, is defined. All righty. And the surviving spouse, if there is one, is often entitled to the benefits if the employee passes away. All right, but remember, as sweet as that may sound to you, if it does, there were 64 Fortune 100 companies who offered them in 1998. By 2016, there were only 2. And we're in 2020, and we are about to be in a post-COVID-19 pandemic era. What do you think that's going to look like at that point? According to 2017 Social Security Administration estimates, about 1 in 4 65-year-olds will live past the age of 90. Alrighty, my paternal grandmother lived to 92. I have neighbors who are 90s. I said neighbors. You can think of people whom have passed the age of 90. Collecting Social Security earlier than full retirement age can decrease your benefits by up to 30%. I have clients now that are like, hey, what can I pull from my annuities over the next couple of years because I'm ready to get out of this job and I don't want to pull my Social Security, because once you draw the Social Security, you're locked into what is paying the year that you draw it. The longer you wait, the more it pays. So my clients that are saying this are in a position to tap into other sources of income until their Social Security benefits are paying at maximum value because they properly planned. It's called diversified retirement income sources. So healthcare and long-term care, it says 21% of people who enter nursing homes will need care for 5 years or more. My grandmother, she didn't enter the nursing home initially, but she needed long-term care for a total of 7 years. The national average rates for a private room in a nursing home are $253 daily, $92,000 annually. I want to go down to this footnote number 7. That was a 2016 estimate by Jen Worth. So this is dated. Inflation has definitely taken that above that mark, and you know it. The average healthy 65-year-old couple is projected to spend over $288,000 in healthcare costs. Okay, so if you're not going to be retiring as a couple, hey, just cut that in half. You're expected to spend $144,200. Hey, Melinda, thank you very much for tuning in. I just got text messages from our community telling me that I'm supposed to be on the prayer line. So you're gonna get in trouble with me. But thank you for tuning in. Yeah, you absolutely need to be looking at this. So hey, if you have any specific questions, Melinda, did I drop the link? I don't think I did. So let me drop that link really quick. If you want to get some estimates of what your current savings looks like, based on when you desire to retire, that'll tell you whether or not your expectations are realistic, or if you need to beef up some things, maybe add some additional income, etc. So I'm going to drop the link in there right now, and you can come back for the replay. The replay will be up for a couple of weeks, I guarantee you. You can also, if you submit an inquiry, let me know if you want to be added to the email distribution list that receives the replay of this after it is removed out of this group. All right. Thank you for tuning in. All right. The next consideration is inflation. At historical inflation rates, a dollar today may only be worth 48 cents in 30 years. Okay, that's a no-brainer. We are aware. In fact, based off of the fact that per our footnote, this, they don't give us the date of this, but a lot of our data on here is dated back to 2017 at the latest. So what we know is that the value of a dollar, at least today, is even less. Alrighty, so or expected to be projected to be even less for the equivalent of a $50,000 a year in retirement income today. In 20 years, based off of the value of a dollar depreciating to 48 cents, you'll need $101,640 a year in order to compensate. So if you're making $50,000 today, you need to make sure that you have saved enough to compensate yourself upwards of $100,000 a year if your retirement expectation is in 20 years in order to stay in pace with inflation to maintain the lifestyle that you currently have. Retirement planning, 52% of households at risk of not maintaining their living standards in retirement. Hey, that is a simple endorsement of the previous stat. It says it. Because if you're making $50,000 this year, you're going to need to be able to pay yourself upwards of $100,000 in retirement, assuming that your retirement is 20 years out, in order to maintain the same lifestyle. The result of inflation, the value of the dollar depreciating. Retirees with formal written plans are 2 times as likely to convert a portion of their assets into guaranteed income. Pre-retirees with formal written plans are 2 times as likely to convert a portion of their assets into guaranteed income. Alrighty, so if you have planned, you actually have the ability to change the purpose of properly defined, properly designed assets into that income that you're going to have to create for yourself. All that is saying is wherever you're putting your money today, is it convertible to produce the upwards of $100,000 per year in income that you're going to need in retirement to at least maintain the lifestyle that you have today? And for most of us, in retirement, our preference is to have an enhanced lifestyle because, we lose expenses in retirement, or we're supposed to nowadays with us living longer and consuming foods and air that is not really meant for human consumption. We're really just when we lose expenses such as mortgage, no more mortgage payments, no more student loan payments, no more auto loan payments. When we lose those expenses, we literally convert over to healthcare. We really convert those dollars. The purpose of those dollars are repurposed for healthcare for most of us to continue to maintain our health. But for some of the lucky, some of the more privileged, privilege does not necessarily mean money. It may be more privileged in terms of resources and access. You actually may experience a raise, an enhanced lifestyle in retirement if you are putting your money into resources today that you can convert to pay yourself an income in the future. So, hey, I've been on now. I've been on for, let's see, do I have a timer here? Almost 15 minutes, and I don't like to overload you. So I'm going to have to continue this. I wasn't planning on it, but I'll come back. Alrighty, so I'm going to close this out. I hope that this was valuable to those of you who were able to tune in. Thank you. If you are in on the replay, that is wonderful. If you have any questions or concerns, please do not hesitate to drop comments. However, the best way to get a response from me is to submit the inquiry, okay? I also value and appreciate your feedback. So it might not be a question or a comment that you have, but you may have some feedback for me. I welcome that too. I'm dropping a link right now that is a survey so that you can tell me how to enhance the material and the delivery of it to you. Feel free to share this with someone. Invite people into the group. This is a closed and private group, so only members of the group get to see this content. If you would like to have access to this content beyond this group after it is removed in the inquiry that you submit, let me know, and I will add you to a mailing list for that. I'm praying that you guys are well, that your mental space is clear, that you're keeping yourself active and engaged with as much positive content as you possibly can, that you're centered and that you're focused on what matters, and that you don't lose sight of the fact that when this is over, it's like when you go on, well, it's a horrible analogy, but something like when you go on vacation and you return back to life, back to reality. So everything that was going on prior to, you're going to be in solution mode. You're going to be in restoration mode when this is over. So don't get too relaxed. For those of you who aren't hit hard by COVID-19, make sure that you're ready. And that is what this content is about. This content is about making sure that you don't lose sight of a responsibility that you're all going to still face. Because you had it coming pre-COVID-19. It's still going to be there post-COVID-19. You're still going to want to be able to have some type of retirement opportunity. It may be set back a couple of years for some of you, but it may not if you know your options. And that's what this content is about. Thank you. Have a blessed day. Peace.